In this week's Property Insider Chat, Dr. Andrew Wilson and I share with you the latest housing market data for the month of November, and that's going to surprise some people. We also talk about the Reserve Bank's apology to mortgage holders for getting its forward forecasts wrong. We discuss what's happening with our economy, and particularly with employment, and we break down what's happening with our auction markets, which gives us a good in-time indication of how our property markets are behaving. So if you want to keep up to date with our property markets, please subscribe to this YouTube channel and click the little bell icon so we can give you an update each time a new show comes out. We're at the end of another month, almost the end of the year, and it's time to see how our property markets performed over the month of November, in fact over the year. And boy, have the housing markets had a lot to cope with this year. Floods, health issues, geopolitical problems, federal elections, and the continual barrage of predictions that our property markets would collapse. And despite all those negative predictions getting a lot of airtime in the media, they haven't come true. One of the lessons I learned years ago was that if you read last year's predictions and see how they transpired, you'll never take this year's predictions seriously. I think you should read fewer forecasts and more history, because there's a lot to learn from how the fundamentals of our property markets work. So how have our property markets performed over the last month? That's what I want to ask Dr. Andrew Wilson, Chief Economist of My Housing Market, in this week's Property Insider Chat. Hello, Andrew.
Hello, Michael, and we have come to the end of another month. In fact, we've come to the end of a season. It's been an interesting spring market. It's been a market of revival. I think that is clear. We're not bouncing back with all the energy that is driven typically by lower interest rates and fear of missing out energy. It's been a flattish but consistent recovery in most markets over spring. And of course, we know that we'll peak out as we move through November. December is that month where buyers particularly start to get distracted by the forthcoming holiday season. So we typically do see, particularly auction clearance rates, always ease from those seasonal effects of the end of the year. And it means there's more stock on the market, more choices for buyers. There are fewer buyers, so clearance rates fall away. But that's just that typical seasonal effect of late November and December. But the monthly price data, again, reinforces, Michael, that slow but steady recovery that we've been seeing over November. We had all capital cities reporting higher prices. Now, these prices are asking prices for established houses as listed. So we tend to see some higher results compared to sales prices, which do reflect a more backward-looking environment. So this is a bit more of a real-time environment when we do use those asking prices. And as I mentioned, these are established houses. So it doesn't cover the new house market, which is covered by other modelers of house prices. So let's get to the results. All markets, with the exception of Sydney, were higher over November compared to October. The top performer was Perth, up by 0.6% over the month. But these were modest increases over the month. And I guess we're not surprised at that, given the gradual revival in market activity and rising confidence. Melbourne and Adelaide were up by just 0.1%. So they were basically flat. And Brisbane up by 0.4% over the month. When we look at the annual figures for established asking prices for houses, Brisbane and Adelaide are still well ahead of where they were a year ago. Perth is up quite solidly also over the past year. Melbourne around about where it was a year ago, up by 1.2%. And similarly, Sydney around about where it was a year ago, down by 0.8%. Some more positive, but certainly gradual signs of an improvement over November, Michael. And of course, as I mentioned before, we are now heading into the holiday season, where there is certainly a significant decline in activity, particularly activity in the mid to higher price bracket. We would expect to see some seasonal easing in prices over the next month. And when we look at the more volatile unit market, Michael, we had three of the capital cities record increases over the month. Sydney up by 2.4%, Melbourne up by 0.4%, and Adelaide, a strong result, up by 4.2%. Brisbane down by 1.6%, and Perth down 0.2%. Similar results for the annual figures, Michael, for established unit prices, asking prices. Brisbane and Adelaide well up from where they were a year ago. Melbourne and Sydney steady, but Perth unit prices are down compared to a year ago, and that's a little different from the house price annual changes for Perth. But it is a small market, that Perth unit market, Michael, so we do get some volatile results from month to month. So overall, I think there's some more positive results here. As you mentioned, those predictions of catastrophic house price falls certainly aren't coming to bear. There's no doubt that it's been an easing market through winter and then a consolidating and rising market through spring, I believe. So the portents are certainly good for next year, particularly given the strong demand that will come into markets from migration. Do remain undersupplied. Where will they live? That's a good question. But also we are now getting some more, I guess, significant signs that we may be just starting to see inflation becoming a bit more controlled. And also we may see the interest rate rises peak earlier and lower than many have predicted. And the latest data is reinforcing that likelihood next year, Michael.
Well, before we look into that extra data, Andrew, some people are going to say, hey, but other research houses are showing different figures and property values still falling. So I just want to reinforce what you said. These are asking prices, yes, and history shows that they are a leading indicator. They show what's going to happen a couple of months down the track when eventually those properties that we're now asking a price to sell eventually sell. So this is not a surprise. It gives us a good indication of what's ahead, Andrew.
Yeah, and I think the important thing is that most data models are showing similar trends, Michael, and that's the point, that the trends are all the same. Different methodologies, some use monthly, some use quarterly, some include new houses, some only use established properties, and some use sales prices, which are always incomplete because the data for sales is very much lagging, whereas listings data measures the full market in real time. So that's a more comprehensive view of the market. But nonetheless, all the trends really are showing that. Particularly the shorter term trends. And I think it's very important, Michael, that you don't stand on just one methodology in terms of measuring market activity. It's not just about prices, which can be problematic in the shorter term. It's also about other factors such as auction clearance rates, which we know are a very good leading indicator of housing market activity. And also average days on market can also indicate what's happening in our housing markets. And we know that auction clearance rates and average days on market are clearly supporting what we're seeing with the house price data, with higher auction clearance rates and lower days on market.
Well, the cloud hanging over our property market has been lack of consumer confidence.
Yes.
And that's a lot been related to rising inflation and rising interest rates and not knowing when it's going to end. But there are some pointers now that maybe the Reserve Bank is going to slow down. More recently, finally, retail figures showing that the interest rate rises are starting to affect how we're spending, Andrew.
Yeah, very interesting times. The latest data, Michael, of course, from the ABS is the preliminary retail sales data for October. It shows the first fall since December last year in retail sales turnover. Seasonally adjusted data. And of course, that data last year was affected by lockdowns. It's the first real sign, a fall of just 0.2%, but a fall nonetheless. And numbers are still very high, let's be clear here. And certainly retail spending is well ahead of where it was at the pre-COVID levels. But nonetheless, it's got to start somewhere, Michael, and it's the first sign that interest rates are having an impact on consumers. And that'll be something that the Reserve Bank will be happy about, because it shows that their policies are doing what it's supposed to do, and that's to stop people spending, to stop creating increased backlogs in terms of supply matching demand. And I think it's interesting, Michael, that before even those retail sales were released, perhaps we could start to speculate that interest rates would peak earlier and lower than predicted. The Reserve Bank, of course, over the past 2 months have only increased, and I mean only in a relative sense, by 0.25%. Following that raft of increases by 0.5%. I think it was a bit of a shock when we did get that 0.25% increase over October. Most were expecting another 0.5%. That was followed up by the Reserve Bank in November, increasing again by 0.25%. And when we read the minutes, the latest minutes from that November meeting, Michael, I think it's instructive that the Reserve Bank mentioned that it was prepared to leave interest rates on hold for some time, or on hold, to wait and see the impact of rates on the economy. I think the reason we've had lower increases over the last 2 months than the previous periods was that the Reserve Bank was recognising that it has a lagged effect, interest rates, and that it didn't want to push rates up too high with a risk of cracking the economy, which of course is performing spectacularly at the moment. And I think that the mention, which they did in the latest minutes, that they're prepared to leave rates on hold was perhaps a signal to markets that don't be surprised if we don't move interest rates either over December or perhaps over February. Of course, December is the last month that the Reserve Bank will be acting for the year, and typically that has a bit of a non-effect similar to the housing market. People are distracted, so changes in interest rates can really pass through to the keeper. But I think that the Reserve Bank is signalling that it's happy at perhaps the level that interest rates are at, that it might wait and see. I still think it's an outsider, don't get me wrong, that they put it on hold, but I think that there's now an increased likelihood that rates may be left on hold over December or February, given that retail sales data is heading in the direction the Reserve Bank wants it to. And overseas, it's still working in our favour. We could say the price of oil has certainly stabilised just above $80 US a barrel, that $130 US a barrel at its peak earlier in the year, which of course was driving inflation. And the interesting thing out of the US is that inflation fell for the second month in a row over October in the US, and it's not that far above us now. And they have certainly more significant problems in terms of higher wages growth, which is fueling inflation. So look, a couple of signs just emerging now that can give us a little bit more confidence in terms of the outlook for inflation and interest rates, Michael.
One of the things that surprised me over the week was the Reserve Bank Governor, Philip Lowe, apologised to Australians who took out debt based on the bank's flawed guidance. He said that rates wouldn't rise until 2024, and his words were certainly he's sorry if people acted on what they'd said, and he now regrets that they've done so. Andrew, he was speaking in front of a Senate committee, and he said he was very glad that workers are now receiving higher wages, and he didn't think that increased labour costs would go on to give that wages price spiral that we experienced in the 70s. So the Reserve Bank did something that I haven't heard him do before. He actually apologised, but he said it was the right thing to do at the time. Looking back, he should have maybe chosen different language.
I thought it was extraordinary, Michael, and I thought it's been a long time coming, and the Reserve Bank has form here. It is not just about their predictions that rates wouldn't rise until 2024. They also made mistakes with their forward guidance back in 2016 and 17 and 18, and created policy decisions from that were harmful to housing markets and our economy, in my opinion. Of course, during that period, the Reserve Bank was telling everybody who wanted to hear that the next move in interest rates would be up. And of course, that was completely wrong in terms of what actually did happen with that sharp declines through the back end of 2019. Now, those predictions from the Reserve Bank of higher interest rates worked their way into policy positions in terms particularly of APRA, the risk manager for the banking sector, who restricted credit to investors on the back of those Reserve Bank predictions of higher interest rates. They felt that that was a risky environment for investors, higher interest rates. And of course, that credit squeeze on investors has lasted really until the beginning of 2021. And it has, in my opinion, resulted in a chronic undersupply of rental properties, with a lot of stress now on tenants having to pay higher rents because of a shortage of rental properties. So maybe the Reserve Bank should also apologise for its problems in its forward guidance that it made previously in regard to its predictions of higher interest rates. I think this is quite extraordinary. It really does reflect the culture of the Reserve Bank in being, I think, a little bit fast and loose with its predictions. And also, the Reserve Bank has had a real focus on the housing market. I think that this bank will be characterised by its focus on the housing market. And of course, its predictions in terms of house prices, just as its predictions on interest rates, have been completely wrong. Again, as we've discussed here, forward guidance, shouldn't be in the realms of the Reserve Bank, putting forward its predictions, and it can only lead to not just, erroneous policy outcomes, but stress in the community. And I just think this is quite extraordinary. But Michael, this has been a long time coming. Reserve Bank has form with these problems, not just the latest ones, but as I said, going back to previous predictions, and also in terms of its seemingly obsession with housing markets. I thought that the Reserve Bank governor at one point was asked last year, I think, in regard to or earlier this year, where house prices were going to go. And then he responded by saying, we shouldn't give forecasts on house prices because, that can be very dangerous. And then he went ahead and gave some forecasts.
Yes, that's right. Yes, I forgot about that. That's right. And then he said, even though I'm saying it, it's not a forecast.
Yeah, and then but this isn't a forecast.
That's right.
Anyway, we move on, I suppose, but we need to do better than that. This is a very important part of our economic process, is the Reserve Bank, and we are in very uncertain times in terms of inflation. And we need to get it right, and we need to have the people there who can get it right.
Well, another factor affecting our economy, Andrew, is unemployment or employment figures. And unemployment figures kept dropping. It eased to 3.4% in October from 3.5%. Employment rose. Andrew, it seems that the 7 consecutive rate hikes totaling, 2.75% so far, haven't dented the job markets, and wages growth went up slightly, represented by the wages price index.
There's a lot of good news around, Michael. I think the good news is sort of working its way through all the doom and gloom. That's why our housing markets have picked themselves up and are sort of shaking off all the predictions of crashes. I think that the strong economy is driving that. If we look at the capital city unemployment rates for October, Michael, they are just spectacular. We can see that basically everybody's got a 3 now in front of it, all those capital city markets. And if we look at the Sydney unemployment rate, capital city economies, the Sydney unemployment rate is now at 3%, Michael, which is quite extraordinary. In fact, the male unemployment rate in Sydney is below 3% now. Full-time unemployment in Sydney for males is below 3%. I shouldn't have to say this, but this is a record low. In fact, we've gone through a period of record low unemployment. First started being modelled back in the early 90s, so we're not going back as far as the national data, but certainly a 3% unemployment rate is unheard of, Michael, in Sydney, and similarly in the other capitals, and that's why we're feeling pretty good about ourselves, Michael. And we've also seen wages, I think, picking up quite reasonably, certainly not at the levels. Our wages growth is just over 3% now. The US and the UK are over 5%. That's why they have bigger problems with inflation. And our unique wage setting system, which relies on those annual reviews, enterprise bargaining, has held us in very good stead in these inflationary periods. And let's just hope that governments find the wisdom not to fiddle with a system that is clearly working, and working where we really need it and when we really need it to work.
Andrew, you carefully watch the auction markets and report them before most others do every Sunday on LinkedIn and on Property Update. And I like the way that you actually separate houses and units compared to just the general reporting others do. We've finished the spring auction markets now. There's still a couple of weeks of auctions happening, but as you said already, there are some distractions in December. The spring auction markets gave us a good indication of what's likely to be ahead, how buyers and sellers are feeling.
Yes, Michael, we had the last weekend of spring, of course, last weekend. Sydney market numbers were up substantially. Of course, the weekend before, Sydney had produced its first 70% clearance rate since March, and the trend has clearly been upwards in Sydney. So a good result the previous weekend, but within 100 extra auctions, I think it was starting to creak a little bit, Michael, with more choices for buyers and those distractions we've discussed coming through now, as they typically do at the end of November and into December. So clearance rates were down in Sydney into the mid-60s. Similar in Melbourne. Melbourne's really been a very consistent market through spring with those mid-60 clearance rates, with some still healthy numbers of auctions coming through. Brisbane up a little bit, but we know the Brisbane market can be quite volatile, and we're not getting a lot of reported results coming through in Brisbane at the moment, Michael, but nonetheless still what we call a typical Brisbane result. Adelaide up a little bit following a weaker previous weekend, and Canberra down, but markets are just starting to think about having their usual end of year pause, Michael. But I think that, when we look at the trends, and we can look at the trends for each of the capitals over the monthly period, we can see how markets have recovered from the winter depths. These are the monthly weekend auction clearance rates for Sydney over November, 67.1%. Once upon a time, that would have been a pretty good result, Michael, but we've been so used to boom and bust environments. But the market is certainly tracking well ahead of where it was, all our markets, particularly Sydney and Melbourne, of where they were during similar previous consolidation periods and periods of low confidence in 2018. When clearance rates in Melbourne and Sydney were in the 40s, low 40s. But we're in the mid to higher 70s in Sydney, mid 70s in Melbourne, down just slightly over November compared to October. But you can see that's been a very consistent market. The Melbourne market, Michael, again, just tracking in those mid 60s. Brisbane up and down a little bit, as we said, following its very strong auction boom earlier this year and last year. It's moved back into being more of a what we would, describe as a normal Brisbane auction market. Adelaide's been the leading performer, down a little bit over November compared to very, very strong results earlier in spring, but still certainly a seller's market in Adelaide. And the Canberra market has also just started to ease after, but still in clearly a revival mode compared to those winter results. So again, those auction clearance rates and their trends, Michael, give us another indication of where our housing markets have headed. We've been describing this through the winter and spring period. We can clearly see the revival there. It's not a surge. It's just a consolidation of confidence moving back into the market. But I think the growth will start to occur next year, certainly on the trends. And given our expectations are better in terms of interest rates and inflation, we still have the drive from migration to fuel housing markets, which I think we're already starting to see some early signs of. So we await our final auction results over the next couple of weekends.
Well, we'll be back each week with these property insider chats and keep reporting how the property markets are heading. But I think there's going to be some property pessimists who are going to be disappointed as we finish off this year that once again their forecasts were very, very wrong.
The data has shown us that for the last couple of months, Michael. And of course, it takes a couple of months to consolidate the trend, and just so it's not just a one-off. And and we need a number of the data points to also consolidate.
And of course, the thing we haven't mentioned today, but we mention regularly, is what's happened to rentals as well. The rental markets are experiencing a crisis, which is causing rents to shoot up to levels we haven't seen for a long time.
And we'll have the rent report out next week for November, Michael, so it'll be interesting reading again.
Fantastic. Looking forward to catching up with you next week then, Andrew. Thank you.
Thanks, Michael. Good to chat.